This is the one I sent to you guys recently, right?
Yes.
Okay, good.
Yes. Yeah.
Yeah, it's gone through some revisions. I presented it at the Eastern, and I was giving some comments, so I
Maybe they are yet to come. Wow.
So are we, as if, what time is it now?
4:30. 4:29.
My phone is off.
Maybe I should turn this off.
So are the discussants here? Oh, we are discussing each other. Okay.
Yeah, multitask.
Good afternoon. We are looking at the session on money and, wait, what is the session's name?
Finance.
Finance. We have 4 papers here, and we are going to have each presenter have 15 minutes to present the paper. Where are the yellow cards? The yellow, no? Each presenter shall have 15 minutes, and then the discussants 5 minutes, so that will be 20 minutes, and we have 10 minutes for questions and answers. In the interest of getting all the papers presented on time, I would suggest that we have each paper presented and the discussants discuss the papers, and after we have finished all 4 papers, then the audience will direct questions at us individually. That way, everybody will have a chance to discuss, to present their paper and get it fully discussed by the discussant who has read the paper fully. So if we agree, I don't have a yellow, so I'll just do like this for 5 minutes. So the first paper here is by Mr. Cantah, Dr. Cantah, William Cantah. The paper's title is Crude Oil Prices and Economic Growth, the Case of Ghana.
Okay. Yeah. Good evening. I'm trying to look at crude oil price and economic growth in Ghana. I'll start by looking at some background information about the oil price and growth relationship in Ghana, and then basically crude oil is an important source of energy in Ghana. Why? Because it provides a larger share of the energy needs of most productive sectors of the economy. If you look at the agricultural sector, about 97% of its energy sources are from crude oil, 92% in the transport sector, and then 52% in the formal manufacturing sector, clearly indicating that changes in the oil price of crude oil may have significant effect on growth of the Ghanaian economy. Now, Ghana has discovered oil recently, but we still depend largely on imported crude oil, especially finished petroleum products. We import finished petroleum products to meet domestic demand of the commodity. So this clearly makes the country very vulnerable to changes in the world price of the commodity. Now, if you look at the economic history of Ghana, we try to look at the period between 1973 and then 1983, which can be seen as the darkest moment of in the Ghanaian economy, where we were experiencing negative growth rates during those periods. Aite and Harrigan, in a paper which was written in 2000, attributed this poor performance in economic growth partly to the high oil prices that occurred in the 1970s that resulted in that situation. Now, if you look at the more recent data, in 2008, when we had these global oil price hikes, with oil price reaching about $147 per barrel in July 2008, you had inflation rate in the economy doubling to from about 10.9% to about 20.8% by the end of 2008. Budget deficit in the economy rose to about 14.5%, with the currency of Ghana, the cedi, depreciating against the US dollar by some 50%. Now, it is therefore important to look at the kind of relationship that may exist between oil price changes, world oil price changes, and the growth of the Ghanaian economy. Now, we are interested in this study because related studies are relatively few, and most of them are concentrated on the Nigerian economy. When you come to Ghana, so far, I have only come across 2 studies which try to consider the monetary implication for monetary policy of changing in the world price of crude oil. Now, the main issues with these previous studies are that they fail to, or they ignore the effect of fiscal policy in the relationship between crude oil price and the growth of the Ghanaian economy. If you consider a paper written by Batumiti and Das 2012, they argue that in most developing economies, anytime you have oil price hikes, governments come in to provide some form of subsidies for this for their citizens to reduce the effect of such oil price hikes on their living standard. So if you are looking at the growth of the relationship between economic growth and oil price, there is a need for you to control for the effect of fiscal policy in relation to the oil price. And then also, they analyze the dollar price of crude oil on the growth of the economy. However, a study by Mock and Osley in 1994 indicated that the use of the dollar price, though, is an indication of disruptions in the world market, but where you, in a situation where you have some price controls, which is always the case in the case of Ghana in relation to oil price, where you have exchange rate fluctuations in the economy, where you have government subsidies and some taxes in relation to the oil price, the use of the dollar price of crude oil does not really give a clear picture about the domestic situation. So there is the need to convert the dollar price at the exchange rates, pertaining exchange rates, into the domestic price level to do your analysis. And then also, most of these studies tend to use the vector autoregressive framework. However, a study by Kallon and Granger also argued that the use of such model does not bring out a consistent estimation of the relationship between crude oil price and growth. So as a result of this study attempts to examine the kind of relationship that exists, controlling for fiscal policy, and then using the domestic price, the cedi price of crude oil, international cedi price of international price of crude oil, and then using the autoregressive distributed lag model to estimate the relationship. Why are we much more concerned about the fiscal policy? Now, a report by the Center for Economic and Policy Analysis in Ghana noted that in 2002, the government spent about 2% of GDP in subsidizing petroleum prices. An attempt was made a year later to introduce an automatic adjustment system into the pricing of petroleum products, so that whenever there are changes in the world market, it will be translated onto the domestic user of crude oil. This resulted in a 90% increase in crude oil price for the first time in 2003. However, getting closer to the 2004 elections in the country, this automatic adjustment system was abandoned, with the government ending up to subsidizing petroleum products to the tune of 2.5% of GDP by the end of 2004. A recent budget statement by the Ministry of Finance and Economic Planning in 2010 indicated that the government spent an average of $432 million annually on subsidies on crude oil related products. Now, we attempt to summarize the kind of theoretical relationship that has been provided in the literature in this framework on how changes in the world price of crude oil tends to translate into the domestic economy. We have the trade/exchange rate channel, the fiscal channel, the price channel, and the monetary policy channel. So the assumption here is that the demand for crude oil is inelastic. So irrespective of the price, quantity demanded may not change. So anytime there is an increase in crude oil price, means that the value of import is likely to go up, is likely to be affected per the amount of oil imported into the economy, which affects the trade deficit of the economy and then the exchange rate, and as well as the current account balance of the economy, which also feeds into the GDP of the economy. Now you come to the fiscal aspect, and some taxes are imposed on the importation of crude oil as well, and then some subsidies are also provided. So you see that the transmission from the world price to the domestic economy is not full. The pass-through effect may not be full, where you have some subsidies in place for the domestic users of crude oil. And this situation, the amount of subsidies may affect the fiscal balance position of the government, which, if the government wants to solve, may resort to internal borrowing from the domestic financial market, which may have an effect on interest rates within the economy, which translates into its effect on domestic investment and on GDP. Now, some empirical literature that we have in place, you see that most of the existing literature focused on the use of VAR and then the vacuum models in their estimation. Now, the two main studies in Ghana did not find any direct relationship between oil price and growth. Rather, they saw that increases in the world price of crude oil affected the economy through increases in inflation rates within the economy. So we attempt to estimate the model, the relationship between oil price and growth by adopting the solo growth model, but we simply stated a Cobb-Douglas production function here with the normal Cobb-Douglas production function we all know. However, with our total factor productivity, we assume it to be equal to be a function of the world price of crude oil in CD, in the Ghana city, government expenditure, real effective exchange rate, consumer price index, money supply, and also to capture the effect of fiscal policy response to changes in the world price of crude oil. We interacted government expenditure with oil price to help capture that effect. And then, since our study spans from 1967 to 2011, we put some dummy variables there to capture the economic reforms that occurred in Ghana in 1983. So the final model that we estimate is equation 5. We have already defined the variables over there. K is gross capital fixed formation, and then L represents labor. Most of our data were sourced from the World Bank Development Indicators and the British BP Statistical Review 2012. Now, as normal with time series models, we first of all examine the time series properties of our model, and then we conducted the co-integration test based on the autoregressive distributed lag model as I indicated earlier. And once we are able to determine whether there exists a co-integration relationship between the variables, then we estimated the long run and short run relationship. This is the results of the unit root test. Since I have less time remaining, I'll just move on to the main results. Now, the co-integration test, the F statistics is above the lower and upper critical bound provided by Pessaran and Pessaran in 2009. Their book 2009 is greater, so at 10% level of significance. So we reject the null hypothesis that there is no co-integration between GDP and our explanatory variables of interest. So our main results, all the variables of interest were significant at the conventional level of significance with the right signs, with the exception of money supply. And to look at the effect of oil price on growth, because we had an interaction term over there, we tried to find the first differential to identify the effect of oil price on growth. So over here, we substituted the mean value of government expenditure after the first differential into the equation to get this value, indicating that any percentage increase in the price of crude oil tend to reduce GDP by 1.4 standard deviations away from its mean value. And similarly, you realize that the effect of crude oil tends to reduce the positive impact of government expenditure on the growth of GDP. Now, we had an interesting result in the short run.
2 minutes.
The interesting result we had in the short run indicated that crude oil on its own seemed to have a positive relationship with economic growth, but when we take into account the effect of government expenditure in terms of oil subsidies, you realize that the effects turn negative, and government expenditure is also reduced by its intervention in the oil market. This in subsidizing crude oil, this clearly indicate that increase in government expenditure in response to changes in the world price of crude oil does not really help in promoting growth of the Ghanaian economy, because you realize that anytime the government goes into the economy to reduce the effect, basically the government is unable to predict the number of times oil prices will change in a particular year. So it tends to borrow from domestic financial markets to pay for these subsidies he's providing. So this situation results in some crowding out effect of domestic investors and tends to have negative effect on the growth of GDP in the economy. So basically, okay, these are the post-estimation results which indicated provide the robustity of our estimation. And the stability test, we use the plot of Kusum and then Kusum square, which indicated that our estimation was stable over the period. So we conclude that increases in crude oil price is detrimental to the growth of the Ghanaian economy, and government expenditure in response to such increases has not been helping the growth of the economy. So we advocate that the government should completely eliminate fuel price subsidies, and as a way of cushioning the poor, some taxes are imposed on crude oil imports into the country. Maybe the government can think of reducing those taxes, and possibly the Ghana Energy Commission should consider other alternatives as a way of solving the oil price situation. Thank you. I'll end my presentation here.
You can mind me 5 minutes, right? commenting on this paper. The paper, as we have heard, I'm having a technological problem here. The paper, as we have heard, looks at the relationship between crude oil prices and economic growth in Ghana. For most developing countries, we know that crude oil prices have been a key issue, particularly the ones that are oil importing. And therefore, the paper itself is very, oh, the stopwatch, the paper itself is very timely. The paper itself is very timely. First and foremost, I have to say that my experience is not very good with the ADRL. I'm just looking at this, so I wouldn't give you any technical advice on, you take it for what it's worth. But so I'm just going to problematize some of your arguments to help you with the paper. Your central argument is that the Ghanaian government responds to crude oil price increases by subsidizing crude oil purchasers, and then this leads to budget deficits, and that leads to a negative impact on the economy. You use the crowding out effect to explain this impact, meaning that the government essentially competes with the private sector for loanable funds, and therefore when the government gives these subsidies, then of course private investment is messed up. My question to you then is, suppose the government did nothing. You have already indicated in the paper that much of the agricultural inputs, much of the Ghanaian industry uses crude oil very intensively. So if crude oil prices rose, cost of production rises, aggregate supply shifts up, Ghana experiences stagflation. Now, suppose the government did nothing. What would that do to business confidence? Essentially, I'm bringing the Keynesian argument of crowding in. Government expenditures creating a confidence from the private sector. Taxi drivers realize that now they can drive the taxi without charging too much because they are getting lower prices for gasoline and so forth and so on. And so the impact is not all negative. You could have positive impacts, and I think you should consider that. The other question I have for you is that the central argument of the paper is that budget deficits in Ghana are driven by oil price subsidies. If that is true, in the 1990s, there were rare decreases in world oil prices. If the causation goes from oil subsidies to government budget deficits, then we should have seen government budget surpluses in the 1990s in Ghana. When I looked at Ghana's data, I didn't see that. So you need to explain a little bit more this causation. I was curious as to why you use CPI in your regression when really the GDP deflator is the proper price index for real output for GDP. I would have loved to see how your results would come up with respect to that. You ran a unit root test. The power of the unit root test depends on the deterministic terms that you put in the equation. There is no discussion in the paper as to why you just use the constant and not a trend. At least if you looked at the data and you said there was no trend, that would be impossible. But if you saw a trend and so forth and so on, then you need to explain in your paper why you felt that you need just a constant. Finally, you have these endogenous variables that you put together. And as I said, I don't know much about the ADRL. I use more the Johansen method. Suppose there were more than one co-integrating relations between your variables. What I see is that you have forced, without giving us any co-integration test results, you have forced a single co-integrating relationship. And I think your readers will want to know whether there will be more. I can easily see, based on your argument, if government spending is driven by oil price increases, then government spending is also endogenous. And therefore, there may be quite a few of those. I enjoyed reading the paper, and I just thought that I'll give you those comments to help you improve it. Oh. The next paper is Stock Market Development and Assessment of its Economic Impact on the African Perspective.
Good afternoon, ladies and gentlemen. I am Jeevita from the University of Mauritius, and I am still a PhD candidate, and I will be presenting this paper, Stock Market Development, an assessment of its economic impact from an African perspective. Just a word of caution, this is still a work in progress, so I would really appreciate if you have any valuable comments and suggestions which would help me. So I'll start off by introducing the topic. The idea that financial development is very important for economic growth has been here since a very long time. Historically, the research has been confined solely on banking sector development. In the recent past, however, with the phenomenal growth of equity markets worldwide, the focus has been duly shifted towards investigating whether stock market development also has an impact on economic growth. Now, although the link between stock market development and economic growth has been subject to a lot of studies, there is still a certain level of controversy which exists, and causality is still pretty hard to pin down. Moreover, there is a scarcity of studies that analyze this particular relationship in the African region. So basically, the link between stock market development and economic growth can be split into three distinct categories. First, there are those who argue that the link is actually a positive one. This positive link can be further subcategorized into three groups: the supply-leading hypothesis, which argues that stock market development actually stimulates economic growth, or the demand-following hypothesis, which actually claims that it is stock market development that appears as a consequence of economic growth, or even a bidirectional causal relationship. That is, stock market development is promoting economic growth, and at the same time, economic growth is simultaneously helping to boost stock market development. On the other hand, the link between stock market development and economic growth can also be a negative one. Indeed, there are a few studies that have found that stock market development can actually hinder economic growth. Yet another interesting possibility is that there might not be any links whatsoever between stock market development and economic growth, although the number of studies that support this particular view are much fewer in number. Theoretically, stock markets are believed to enhance economic growth through the services that they provide, either directly or indirectly. One of the main channels through which stock market development can boost economic growth is the liquidity channel. Moreover, stock markets also offer global risk diversification opportunities as well as help in enhancing savings mobilizations. Another important role that is carried out by the stock market is the dissemination of information and the acquisition of information. Moreover, stock markets also help fostering corporate control. So all these channels will eventually help enhance economic growth. Now, as far as the empirical literature is concerned, there are a wide variety of studies that have been carried out, be it on a country-specific basis or across a panel of countries, and different methodologies have been used, including OLS regressions, cross-country regressions, fixed effects or random effects panel estimations, and even dynamic VAR or VECM models. However, most of these studies tend to focus on analyzing the relationship in developed countries, and only a few try to investigate whether developing countries such as Africa tend to behave similarly. So zooming in on these studies, we find that there is still a certain level of controversy that exists. While there are some studies which find that the link is positive, there are still a few studies that find that the link is actually negative, or some even fail to detect any significant links between stock market development and economic growth in the African region. As such, in an attempt to shed more light on the matter, this paper aims to determine whether indeed there is a relationship between stock market development and economic growth within the African region. And if there is a relationship, then what is the nature and the direction of this relationship? So to carry out this study, we make use of a panel VAR framework, which actually combines the traditional VAR approach along with panel data econometrics. Moreover, this paper considers both banking development and stock market development together in a unified framework, and this actually enables us to determine whether stock market is actually complementing banking development or whether it is substituting the latter. So we make use of an unbalanced panel data that covers the years 1988 to 2011, and the African countries that are under investigation in this paper are listed here, and they were chosen mainly based on the availability of data. So this slide here illustrates the model specification that is used in the paper. Drawing from several previous studies, we adopt the following model where real GDP growth is taken to be as the dependent variable, and it is a function of stock market development, banking development, and free control variables. That is investment, trade openness, and human capital. So to measure stock market development, we make use of three proxies. A measure of stock market size, that is market capitalization ratio, and two different measures of stock market liquidity, that is turnover ratio and total value traded share ratio. Banking development is measured through domestic credit to private sector, while investment has two indicators for indirect investment and gross domestic fixed capital formation. On the other hand, trade openness is captured through the sum of imports and exports to GDP, while human capital is measured by secondary enrollment ratio. Now, before proceeding with the estimation of the model, we have to carry out a few preliminary tests. First, we try to find out whether the variables are stationary. To do so, we make use of a panel unit root test, and we find that all the variables are actually integrated of order 1. Now, since this is the case, an interesting question arises. Is there a long-run relationship among these variables? To find out, we resort to panel co-integration tests, and the results actually indicate that there is a co-integrating relation among the underlying variables. Now, since the variables are actually integrated of order 1 and the presence of a co-integrating relation has been detected, we therefore proceed with the estimation of a panel vector error correction model. So this slide here actually displays the long-run relationship of the model. We are able to analyze how each of the different variables affect economic growth in the long run. So of prime importance to this study, we're first going to consider the impact of stock market development proxies on economic growth, that is market capitalization ratio, turnover ratio, and total value traded share ratio. We find that market capitalization ratio doesn't have any impact on economic growth. However, the two other proxies of stock market development do significantly influence economic growth in the long run. Indeed, the coefficient of turnover ratio is found to be positive and significant, which implies that it is actually boosting economic growth in the long run. On the other hand, total value traded share ratio has a negative but significant coefficient. However, if we consider the coefficient, we find that the coefficient of total value traded share ratio is actually much smaller as opposed to the positive boost that is brought forward by turnover ratio. And so we can conclude that overall there is a positive effect of stock market development on long-run economic growth. Shifting our focus on banking development, we find that it fails to have any significant impact on long-run growth. This is mainly due to the high level of corruption or banking and currency crisis and high creditor protection that might exist in a lot of African countries. Another interesting result is that investment seems to have a very important impact on economic growth. Indeed, the coefficients of both proxies of investment are found to be positive and significant. As for trade openness, it is seen to have a surprisingly negative but significant coefficient. Although this might seem to be counterintuitive, there are a lot of factors which might be reflected in this negative link. For instance, there is dire transport facilities, a lack of skilled labor, poor infrastructure, which are actually significantly increasing trade costs and therefore limiting its impact on economic growth. So now we'll have a look at the short-run results of the model. Well, this table actually displays the dynamic system of equations where the current level of each variable is actually dependent on the past values of that variable as well as the past values of all the other variables in the model. In other words, we can interpret each column of that table as a separate equation in which the column header is actually the dependent variable of that equation and the row headers are actually the lagged values of the independent variable. So we analyze each of these equations separately, but to better understand what's happening, we've extracted the major findings of these results and displayed them here. So first we'll focus on the impact of stock market development on economic growth again, but this time in the short run. So to do so, we look at the equation that has economic growth as the dependent variable, and we find that the coefficient of stock market development proxies are actually positive and significant in both cases. So it implies that stock market development is actually stimulating economic growth in the short run as well. Next, we try to find out what the determinants of stock market development are. To do so, we have a look at the equations that have stock market development proxies as the dependent variable. And interestingly, we find that foreign direct investment has a positive and significant coefficient in each of these equations, which means that a foreign direct investment is actually playing a very important role in stimulating stock market development. Next, when we analyze the equation that has banking development as the dependent variable, we find that the coefficient of market capitalization ratio is positive and significant. This implies that stock market development, at least through market capitalization ratio, is actually stimulating banking development. Or in other words, it is actually complementing banking development rather than substituting it. Finally, we also find evidence that stock market development is actually also boosting investment. Indeed, when we look at those equations that have investment as the dependent variable, we find that the coefficients of turnover ratio and market capitalization ratio are positive and significant. So basically, we found that stock market development has a positive and significant impact on economic growth, be it in the long run or in the short run. And we also find evidence that stock market development is actually complementing banking development within this sample of African countries. Moreover, we've also detected a bidirectional causal relationship between foreign direct investment, that is investment in general, and stock market development. So this is about it. Thank you very much for your attention.
Dr. Cantah will discuss the paper.
The paper is quite an interesting one, and given the fact that most research related to financial development in Africa have largely concentrated on banking sector development and ignored the role of the stock market in promoting growth in Africa. But some few issues with the study, probably if you could provide us with some motivation as to the inclusion of some countries like Iran, Jordan, Lebanon. When you read the paper, it does not provide much more information as to the reasons for including such countries. And given the fact that the level of development in stock market across Africa varies, if you consider the stock market of Tanzania, they seem to have very low number of companies, small number of companies listed on the stock market, comparing that to that of South Africa. So possibly if you could separate these differences in countries, probably the insignificant result that you had for stock market capitalization, the effect of stock market capitalization on growth probably may change with respect to that. And then I was also thinking probably if you could consider the negative and insignificant relationship between bank sector development, which you use credit to the private sector as a proxy. Possibly such credits are not used productively in Africa. That's why they tend to be insignificant. I wasn't getting the link you were trying to create between credit to the public sector and as to how it affects that relationship. Because credit to the public sector tends to reduce the amount of money available to the private sector. So you were trying to make a point that that may account for the negative relationship between those two variables. And I wasn't so clear with that. Then, concerning the effect of trade openness on growth, you use export plus import over GDP as a measure of trade openness. So I was just thinking aloud. Possibly you see most African countries tend to be net importers. So if we are net importers, it means the effect of such openness. That means we import more, so the effect of that measure of openness will tend to be negative because you are going to have a deficit in your trade balance, which will definitely have a negative effect. You could see that in the short run analysis, trade openness seemed to be positive. I don't know, I'm not so sure. I think it was positive. That could be possible because short run imports are used because of the nature how they are used. I was thinking possibly this new data set in the World Bank doing business indicators, where you have cost of import, cost of export, the number of days it takes to import from one country to the other, in relation to the number of documentation one has to make, if you could try to get an index out of that to create an openness data which rather reflects the ease of trade within an economy rather than the traditional measure of openness which has to do with import plus export, possibly you may not have this negative relationship that you are currently having. Basically, those are my comments. Thank you.
Okay, the third paper is being presented by Dr. Morales.
Okay, thank you. The origin of this project was to discuss monetary transmission issues in East African community countries because of their plans to become a monetary union eventually. And the idea was to see where they stood that time and what could be realistic plans to harmonize their monetary policy frameworks. But in the meantime, we discovered that most of the debate became about monetary transmission as such. If the countries were ready to have a common monetary policy framework, given that the signs of strong monetary transmission were not really there. So I was supposed to have an outline somewhere, but it's disappeared. It's the other. Okay. So the idea is to look first at the issue of monetary transmission and try to really look into the reasons why the evidence shows that is weak. This paper by Montiel and Proxies has been quoted several times today. Then in particular, because most of the skepticism about monetary transmission in East African countries has to do with weak financial intermediation. So we wanted to look more carefully into interest rates and exchange rate channels. So, in other words, instead of having a typical vector autoregression framework to assess the whole process of transmission, that's one possibility. We didn't go that route. We went specifically to assess these channels because of the many unsuccessful attempts to grab the process of transmission using encompassing VAR approaches. Other possibility could have been to use more structural models, but then to compare different countries with the structural models, you can imagine it's very hard to do. So we opted for something in between, to do some partial analysis of these two channels and how do they work in low-income countries in general and in East Africa in particular. So we're gonna look at both interest rates and exchange rate, but on the exchange rate, we're gonna the transmission from shocks to the exchange rate to the economy is something that is easier to assess directly in a simple VAR structure. However, with the interest rate, there is an underlying question that always comes up, which is what is the impact of short-term interest rates on lending rate? And there is this presumption that there is not really a strong link between the two. So we want to look a bit more deeply into that question. And then we discuss what does it mean for East Africa. So I need to go back before we go forward. So the motivation is to look at the specific channels and what is their significance, and we are in some way challenging the hypothesis of weak transmission. We acknowledge that there is weak evidence of transmission, and we acknowledge that financial development is low, but there may be alternative reasons why this evidence is weak. So the question is monetary transmission really weak? Now, one way to look at this is the issue of monetary transmission is not something that came up because of financial globalization or recent developments. So it's been studied for a long time, and therefore, is it really relevant to look at monetary transmission in a low-income country with low financial intermediation? For us, the main reason why we think the answer is that it is relevant has to do with this guy, Copernicus. A few people know his picture, and fewer people know that he was also an economist, among other things. So he found monetary transmission was possible in Poland in the 16th century without anything resembling financial intermediation as we know it. He even have, in the language at the time, some statement saying that actually is the amount of money that is affecting inflation. So that incipient idea of transmission was present in feudal and agrarian Poland. So why now it has become as something that we should all accept, that the low level of financial intermediation condemns countries to not having monetary transmission until they develop further. So the way we look at the evidence is a bit different. So for us, one thing is transmission, which is the response to different policies, and the evidence may show some other problems. So, for example, and it has been mentioned several times today, in Africa is more exposed to volatility, more exposed to frequent shocks. That means reading the data and assessing transmission is more difficult. There were long periods with consecutive policy mistakes, especially in monetary policy. We saw in a presentation earlier today that if you go only halfway, for example, in raising interest rates, that may result in lower real interest rates that may be exacerbating the increase in aggregate demand. So the data is going to reflect the inconsistency of policies more than weak transmission. So there are issues that are more associated with features of low-income countries that we probably need to look at. And low-income countries evolve over time, and even the literature also evolves. So what we are going to do is an ad hoc methodology that is an intermediate step between a VAR and an event study. And the motivation for doing that is because we know that very recently, the food inflation shock of 2011, you can see in the screen that, which one is which? So you can see that the exchange rate depreciated a lot in Kenya during that crisis. The bank lending rate went up, and the central bank eventually raised the policy rate. Uganda, the story is similar, the exchange rate, interest rates. Then it starts to become a bit different. In Tanzania, you see that the lending rate actually doesn't really move that much. The exchange rate did move. So we see a response of the exchange rate in all cases. That means that probably the focus should be on the exchange rate. Second thing, we are looking here at the lending rate, but the lending rate behaves differently, and probably that reflects differences in the financial systems of every country. But one question is, what is the link between short-term interest rates, the ones that the central bank can influence, and the long-term interest rates or the market interest rates like the bank lending rate? So what's the way we see it? The way we see it is that first we need to reconcile the literature with the reality. So we have, the literature says that changes in interest rates are going to affect the cost of capital. We know that this is very difficult to test even in advanced economies. And therefore, probably we need to think again, what is exactly the impact of interest rates on the economy? And probably not so big on investment decisions, but still, as long as this affects the amount of lending that is available or make credit more expensive, it may affect expenditure decisions. Regarding the exchange rate, we know that exports are many times inelastic to changes in the exchange rate, and so that will have a weak, changes in the exchange rate may have a weak impact on exports, and therefore the demand channel through depreciation, for example, is not going to be that strong. However, in practice, as we saw in the charts before, apparently there is an impact on inflation expectations still, and probably that's the most important and the most immediate. And because of the low level of international reserves in several countries, that could be magnified. And the depreciation episodes that we have seen in the region probably are consistent with this. So you see the exchange rate is really a very good predictor of inflation. Some differences in Rwanda, but still, just visual inspection shows that the exchange rate plays an important role. So what we do is we found first some paper that could be consistent with the approach we wanted to take. So we used a paper by Bhattacharya and others for India. And they use a recursive structural bar model, but only to look at the impact of changes in the exchange rate and how that translates into changes in other variables like interest rates, output, and prices. The exogenous variables are oil prices and the US interest rate. So using that basic simple model, what we do is to look at the forecast error variance decomposition for all countries. But we are also interested in knowing if this is evolving over time, as the title of the paper says. And that's one of the reasons why some of my colleagues before are a bit skeptical of using VARs to make a final conclusion about transmission. Because actually, depends on the period that you select, you may get different results. So what happens in the case of the countries in East Africa? So what we see is for the whole period 2000 and 2011, the exchange rate and interest rates play a relatively marginal or zero role in explaining the impact of changes in the exchange rate on prices. So this is all about the impact, how changes in the exchange rate because of an exchange rate shock affect prices. So this is the relative role of each of these channels. So all these horizontal numbers should add up to 100. I hope, yes, they do. So the role of exchange rate and interest rates, if we look at the whole period, is not that impressive, I would say, except for Uganda probably. We see a surprising reaction of the interest rates to changes in the exchange rate. But basically for most of them, it's just inertia. It's an impact, a direct impact on prices that continues affecting future prices, and there is not much role for foreign exchange markets or financial markets to drive this process. However, if we look at a shorter sample, then we see that the story is different. You see exchange rates and interest rates play a more important role in all cases. Tanzania still shows significant inertia, much more than the other countries in the sample, but that is consistent with being a relatively closer economy. So we can see the case of Kenya, the inertia is basically non-existent compared to what it was when we look at the whole sample. And the impact of the exchange rate is much more important now when we look at the shorter sample from 2006 to 2011. And interest rates, although this is mostly to assess the exchange rate channel, but it's interesting to see that interest rates also become more important in some cases, like Uganda, Kenya, not only Uganda and Kenya, even Rwanda. No? You can see that the interest rate was basically played no role, and now it has become more and more important. So what happens with growth? The impact of changes in the exchange rate on growth is weaker. It's still getting stronger over time. In some cases, it's surprisingly strong, like Burundi. It's something we need to probably look a bit more closer. But still, despite that, we see that the impact is increasing. Again, to focus on Kenya, we see the, let's say, less role of a Phillips curve type of effect, and a more significant impact of channels related to the exchange rate and interest rate. So overall, the exchange rate and the interest rates are more important. Inflation inertia is less important. It's just the other side of the story. And the interest rate channel seems to be prominent for longer periods. But again, what about the impact of short-term rates on lending rates? For that, we use a very simple error correction model that's being used by other authors, and we just go to show quickly the results. So you can see that the impact on the deposit rate, the short-term impact, is very significant. This is the discount rate on deposit rates. So deposit rates move first, they react first to changes in the short-term rate. This is lending rate, and this is deposit rate. It's more significant for all countries. But the long-run impact of changes in discount rate on the lending rate is bigger for Kenya, for Tanzania, than the impact on the deposit rate. That means in the long run, the impact on the lending rate is more important than the impact on deposit rates. So although sometimes we look at by visual inspection, it's difficult to assess this impact. But once you put this into a framework, on an error correction framework, we find a strong, close to one-on-one impact of changes in the short-term rate and lending rates, and a very, very significant impact on deposit rates in the short run. So I have to close now. This is just a bit more of the same, but evolution over time shows that these impacts have been increasing for Uganda and Kenya. Probably not for the other countries as much. So let me go to the main findings. So deposit rates are more responsive. Lending rates show a significant impact for the long-run elasticity. The recent tightening episode shows that in Kenya and Uganda, both channels work very well. And therefore, looking ahead, we should expect that all countries in East Africa are going to evolve in the same direction. And that probably justifies moving to a common monetary policy framework in the region. This is still preliminary work, so we hope from your comments this is going to improve. Thank you.
I read your paper with a lot of interest, but I should admit from the start that this is not my specific area of expertise, and I'm afraid that I won't dare to venture into making any specific comments as such. But I would definitely like to understand a little bit more about your choice of modeling framework and the motivation behind it. You mentioned in the paper that you used a recursive VAR model with Koletsky factorization augmented by a vector error correction term. And I was a little confused about the use of the VAR model. Was it just for the error decomposition step, or I didn't see the results of the VAR as such? And then I wanted to know why you used the ARDL method after that. Also, are there any other alternatives, methodologies, which could have been used for this particular research? I was just wondering. And I thought maybe we could replicate this for another African developing country like Mauritius, for instance. And I was wondering what were your thoughts about that, and whether your proposed model and arguments would apply to that. Thank you.
Can you time me? Well, let's do it over there. We had a problem here. So if you just go to start timing when you start. You hit start. Which one is mine? This paper, as the title says, this is, I think, a third iteration of this paper, so the title keeps changing. Foreign exchange and the Dutch disease, evidence from Sierra Leone. My objectives, one is to estimate the long-run relationship between official development assistance, it should be, the trade balance and real output in Sierra Leone. Part of the reason for this objective is simply because that is the causal relationship that the Dutch disease hypothesis holds. But all more important, I see that the literature on the Dutch disease hypothesis has talked about the aid growth relationship, but have never talked about issues of income distribution, poverty reduction, and so forth. So I want to look at the implications of this foreign aid on poverty and income, the distribution of income, since we know, at least the people who give aid argue that they want to reduce poverty and so forth in developing countries, not necessarily promote economic growth, but they want to reduce poverty. And then use my findings to make policy recommendations on how to use foreign aid to achieve the dual objectives of economic growth and poverty reduction. The Dutch disease hypothesis essentially says foreign aid leads to a real exchange rate appreciation. The real exchange rate appreciation makes the country's exports relatively more expensive and its imports relatively less expensive, so there is a deterioration in the trade balance. The trade balance, being net exports, essentially lowers aggregate demand, and therefore there is a reduction in equilibrium output. This model is essentially the way the neoclassical international finance theory looks at the relationship between the real exchange rate and the trade balance and economic growth in developing countries. And that viewpoint actually informed much of the structural adjustment policies that were implemented in sub-Saharan Africa in the 1980s, when the Fund and the World Bank would go and say, reduce your real exchange rates. Your real exchange rates are too high. Another twist to the Dutch disease hypothesis is simply that by raising the real exchange rate, foreign aid reduces the relative price of imports, which leads to expenditure switching away from domestically produced import competing goods to foreign produced imported goods. And the argument is that this leads to deindustrialization. So whichever way you look at it, this argument, the Dutch disease hypothesis is saying aid is bad for developing countries. And in fact, some have argued that the developing countries should use the Asia model and rely more on FDI and loans than foreign aid. Another twist, again, the neoclassical tradition, is the Balassa-Samuelson hypothesis, which holds that labor productivity growth typically takes place first in the traded goods sector, and that leads to an appreciation of the real exchange rate. Now, in a neoclassical tradition, of course, an appreciation in the real exchange rate will lead to net export deterioration. But for the typical sub-Saharan African country, where the export sector is divided into two, you have the cash crop producing sector and then the extractive mineral sector. I am arguing in this paper that actually it is possible that if productivity takes place, as Samuelson and Balassa argued, in the traded goods sector, for most countries in sub-Saharan Africa, the only traded goods produced are being exported. And therefore, I would say it leads to export expansion and economic growth. Now, let me problematize this view of this real exchange rate appreciations, lowering net exports, having a negative impact on economic growth. We look at some stylized facts about small developing economies. They are price takers on world markets. Therefore, for as long as they are willing to accept the world-determined price, they can sell everything they bring into the market. They typically export primary commodities and import manufactured goods. The world prices of these commodities are denominated in the major currencies. So a ton of coffee might be $500. And a Sierra Leonean farmer selling a ton of coffee, agreeing to accept $500, can sell all the coffee they produce. Starbucks, buying a ton of Sierra Leonean coffee, will pay $500 for that coffee no matter what happens to the real exchange rate. So my argument here is that the real exchange rate does not make cash crop or primary producing exports non-competitive as the traditional literature is telling us. Now you could have a situation, so we have foreign induced currency appreciation, where what happens? The farmers that grow coffee and cacao and all of this get an increase in their real incomes as a result of the exchange rate appreciation. When that happens, they have an incentive to produce more coffee and cacao for export. If this argument is correct, then of course exports will increase. On the other hand, when the Leone appreciates in real terms relative to, say, the dollar, the prices of imported inputs fall in the developing countries, giving the import competing industry a cost advantage. As a result of that, I am arguing that it is actually possible for a real exchange rate appreciation to increase net exports in the developing countries and therefore lead to economic growth. Another aspect that the Dutch disease hypothesis doesn't look at is the fact that I've talked about this too. I'm just trying to summarize. What about this area that they have ignored? The relationship between the real exchange rate and income distribution. We know that the stylized facts about the poor in developing countries is they are mostly rural. they engage in agriculture, and so forth. So when we have real exchange rate changes, as I have argued, it directly impacts export earnings. So if the Leone appreciates in real terms, then of course, coffee exporters in Sierra Leone will be receiving more imported goods per ton of coffee. As their real incomes rise and they are relatively poor, then of course, real exchange rate appreciation will increase their incomes. We are talking about poverty reduction. At the other extreme, of course, when you have a real exchange rate appreciation, what happens is that when London Minerals, London Mining decides to go and mine iron ore in Sierra Leone, the prices in terms of pound sterling that they should take to pay for local inputs become higher. So where I see in a country like that, a real exchange rate appreciation can make FDI intensive exports non-competitive and reducing the demand for the inputs that go into that industry, which are usually urban beings, the urban elites who have human capital working for these companies, or the foreign owners of the FDI, and their incomes will fall. So we have rural incomes rising, the incomes of the elites falling, and therefore we are actually improving the situation, no matter what the real exchange rate does to GDP growth. The empirical evidence on the Dutch disease and this whole aid growth relationship is quite mixed. And, you know, I go through them in detail in the book, in the paper, so I'm not going to deal with them here. Only one study has been done on Sierra Leone by Cargo, and he actually found a positive relationship between aid and economic growth. Why is Sierra Leone important in this debate? Well, Sierra Leone is very heavily aid dependent. This table tells us, we just looked between 1974 and 2005, 15.5% of GDP, that was a net ODA as a percentage of GDP. If you look at it as a percentage of government expenditure, you have almost 140% of government expenditure being taken care of by aid. What is the model I'm looking at? Given the discussion we've had, now we look at the relationships that they are trying to make between the real exchange rate and aid. I'm arguing that we can't just simplistically say that when a real exchange rate, when a net overseas development assistance NODA goes up, the real exchange rate will appreciate. We don't know that because it could actually depreciate or it could appreciate. We don't know that. Labor productivity. The Belasa-Samuelson argument is that when labor productivity increases, the real exchange rate appreciates. But what if the workers in the traded goods sector have a high bias toward consumer goods, manufactured consumer goods? As their incomes increase, imports will increase, and therefore we don't know really what will happen. Trade openness, this is the easiest one, because trade openness essentially means that imports increase, exports increase. The whole theory of comparative advantage is that you specialize in the commodity of comparative advantage and you import everything else. So if we just follow the theoretical viewpoint of this, we could also argue that this will be ambiguous. What about government expenditures? The literature seems to say that when government expenditures increase, the real exchange rate should depreciate. Well, it depends on how the government expenditure is financed. If it is financed through taxes or domestic borrowing, the domestic interest rate will rise. The rise in the interest rate will bring in capital flows, causing the causing the real exchange rate to appreciate. On the other hand, if it is financed through money creation, interest rates fall, capital flight, And then, of course, a depreciation of the real exchange rate. So I have that question marked also. Foreign incomes rise, they buy more of your goods, and therefore the real exchange rate appreciates. Terms of trade, the same argument we made with openness. Terms of trade improves, there is an incentive for more exports. But then at the same time, if there is a high taste for imported goods, the exporters will use those incomes to buy imported goods, so we don't know. And Z is just any other variables that will affect this thing. So if we look at the trade balance equation here, I'm arguing that we don't know what the real exchange rate will do, a priori, what the real exchange rate will do to the trade balance. Foreign incomes raises the, foreign incomes leads to a real exchange rate appreciation. But when the real exchange rate appreciates, trade balances could either improve or deteriorate. So we don't know. Domestic income is the only one we can sign, because when domestic income rises, imports increase, and therefore we should expect a deterioration in the trade balance. In terms of real GDP, I just used a simple AK model of the endogenous growth people, where I argue that because of low savings in the developing countries, capital stock in the developing countries would depend on foreign resources coming in. For example, foreign aid, NODA. If the real exchange rate rises, we have already said that the cost of FDI rises to firms, and therefore that will be negative. And Z. When you put all of that, because of these relationships to start with, we get that thing. Let me go straight to the empirical results. First, do unit root tests. Typically, some people will do a unit root test first to try to see whether there is co-integration. The variables are co-integrated. The rats, the cats thing, the co-integration analysis of time series that's embedded in rats, actually will test for stationarity after it had determined the rank of the co-integrating matrix, and then you can test for stationarity. That is a much more powerful test because it will depend on all the deterministic variables that you have put into the VAR. So here we see that we identify a rank of 3. Now, this here is 0.7%. I just don't like, given the fact of data being so unreliable in Africa, I think that I'm willing to accept a type 1 error at 5%, and I don't go above that. So I'm assuming that there are 3 co-integrating relationships, which fits well with the model that I developed. All right. I'm sorry. Now, when you look at the long-run relationships, I have the part in blue highlighted because of the very small, these are absolute values of the T statistics. For trade openness, they are insignificant in the trade balance equation and insignificant in the real income equation. And when I use a 0 restriction on them to try to re-estimate, the chi-square statistics told me that that restriction could not be rejected. So I dropped them out of the thing, and these are my results. When I looked at the graph of the data, individually you see some with trends and this, that. But when I put them together, they seem to be almost random walk variables with drift. So I just put a constant in the VAR. Let's look at briefly the foreign aid variable. Now these are in the long run equilibrium equations, whereas beta 1, this minus beta 2, this minus that. So when you bring it to the right side, the signs change. If we look at this, 0.94, if we bring it as R is equal to, and and that would be minus 0.94 as they do in the Johansen thing. So that tells us that there is a negative and significant relationship between the real exchange rate and foreign aid, meaning that in Sierra Leone, foreign aid actually leads to a real depreciation of the Leone. Let's look at the other equation here in the trade balance. It is negative here, meaning that it is positive on the other side. So real exchange, foreign aid improves the trade balance. And it also has a small positive effect on income, which is consistent with the findings that Cabo had. Let's look at so from this line, the Dutch disease hypothesis is not supported. What about the Belasa-Samuelson hypothesis? Here, they expect this thing to be positive. It is when we bring it to the right side. This to be positive, it is. This to be positive, it is. This is not significant. So there is partial support for the Samuelson-Belasa hypothesis. The other variables, I'll just talk about the war. One would expect that the war would have had a very negative impact on the real exchange rate and all of these variables, but here we have positive. I'm thinking that during the war, the UN intervention and all the other financial transactions that came in, particularly at the later end, skewed that thing. As far as diagnostics, to show whether this is really something we should even take seriously, you need to test for serial correlation. The LM test at both 1 and 2 lags, well, I can reject it at a 5% level. A normality test, again, weakly normal. The arch test, I can reject it at a 5% level. So suggesting that this thing is okay. Another way to look at this is look at the actual and predicted values of the 3 dependent variables. I actually have graphs for all the endogenous variables, but they track their actual values really well, suggesting again that what we have done might make some sense. The co-integrating relations, not much, no significant difference, much difference between the beta Z and the beta R for all 3 of them, suggesting some form of stationarity. Quickly, interpretation. Well, we've gone over this. Dutch disease hypothesis not upheld. Partially upheld the Samuelson-Belasa hypothesis. Implications. Foreign aid-induced real currency depreciation lowers factor returns to rural agriculture and raises FDI-intensive activities. This increases rural poverty. We've seen from the study that the real exchange rate depreciates, economic growth takes place. What this is saying is consistent with what we've been saying in Africa all the time. We're saying economic growth, but increased poverty. This is consistent with that. Policy implications. Since the Belasa-Samuelson hypothesis seems to hold that when there is labor productivity, the real exchange rate improves, trade balance improves, the economic growth takes place, then I'm arguing that foreign aid resources must be invested, should be invested in increasing labor productivity, particularly within the agricultural sector, where poverty is. As labor productivity rises, we have real currency appreciation, which raises rural incomes and lowers factor rewards and FDI-intensive activities, which should reduce the level of poverty and income inequality. Thank you. Oh, I keep forgetting.
Okay, thank you. The paper about foreign aid and Dutch disease, I think it has an interesting hypothesis to see what are the real channels through which Dutch disease may or may not materialize. The paper, I would say, is about much more than that. It's a system that explains the exchange rate and the impact on output, which is a good thing, but could also be making a bit difficult to really focus on the Dutch disease issue. There is a hypothesis basically on the impact of the exchange rate, but in some parts the paper gives impression of looking at the exchange rate as a ratio of tradable against tradable goods, no exports and imports, and we know that it's more about non-tradables and tradables. Probably is the way it's drafted. When you talk about exporters and imports, exporters are price takers, and when they import, they are also price takers. So it's hard to imagine that there is a strong impact coming from that source. But I think there are other areas that could be further explored to make the paper a bit more focused on the Dutch disease issue. And I'm not familiar with the literature, so I'm just telling you a few things that came to my mind. So foreign aid may have, in the case of Sierra Leone, clearly an income effect. It's not substituting domestic production, and it's helping to expand demand. That is even more likely because what you use as net ODA is much more than government expenditure. It's more than 100%. So it's not really foreign aid going to the government, and I suspect it's not mostly in foreign exchange. It's not foreign aid coming to the country in the form of foreign exchange, which is probably the component that is more likely to have an impact on the exchange rate. If you receive services or equipment, etc., and you are complementing domestic supply, the impact on the foreign exchange market is probably going to be less strong, and maybe that explains the results, which would be something interesting to explore. And probably the low significance of the government in your model may be explained by the same factor, that foreign aid is so much larger than government spending that is really the variable that is affecting demand more directly. And so it would be interesting to disaggregate what are the components of foreign aid that are part of your study. I think it's just a matter of perception from reading an issue that I'm not that familiar with, but I think it's very comprehensive. I would say there is probably more than one paper in your work, very interesting findings, but to make it about the topic that the title suggests, probably may need to focus more into the components and the way foreign aid takes place in Sierra Leone. Other than that, I enjoy reading the paper. Thank you.
So can we have the authors 2 minutes respond to the comments of the reviewers, then we can open the floor.
Okay. The first issue you raised was suppose government does not intervene when there is stagflation. Imagine oil prices are also quite high. It will lead to discourage domestic investors. The main issue I was trying to raise was about the persistent government borrowing in the domestic financial market. Probably if the government could get other sources of funding for the subsidies, then possibly the government could continue subsidizing oil prices for the economy, because it's like government is unable to predict the changes in the oil price over the years. So at any point in time when he wants to subsidize, then he only has a choice to go to the domestic financial market to borrow. Currently in Ghana, we have one of the highest interest rates, highest lending rates in the world. It's almost about 40%, which is quite high. So this tends to discourage borrowing. Like credit to the private sector is also relatively low, which affects growth of the economy. So if government could possibly find alternative sources of financing the subsidy, then that would be okay. Then the issue about the 1990s, oil price falling and government deficit still persisting. Probably I did not point out my argument clearly. I was trying to make the point that the deficit we experience in the country is partly due to oil prices, the subsidies the government provide for the oil like what the government provide for oil subsidies. But over the years, what happens in Ghana is that close to every election year, budget deficit shoot up due to the need to gain some vote from these political campaigns. So the deficit trend in the country tend to be a cyclical event mostly. So in the 90s, most of the high deficits we experienced were mostly during election years. For instance, after the reforms in 1983, we were able to operate a very low deficit until 1992, when an election was conducted, and then 1996, 2000, and even in 2008. So some other factors play into the equation. I'll consider the other comments and then work on them. Thank you.
Jeevita?
Yes, so the first question was about the inclusion of the countries, different countries. Well, the problem was that in Africa, generally, stock markets are relatively new, and we had a limited availability of data because there are some stock markets which only recently opened up, like 5 years ago. So we tried to include as many countries as possible, because we wanted mostly to make use of a panel vector to regressive model so that we could, because of all the advantages that are linked to it, which is why we kind of looked at Africa as a whole. And I think the next one was about banking development and the negative link. Well, there is my co-author who is maybe in a better place to explain this, but unfortunately he is not here, so I could probably get back to you on mail. As for trade openness, what exactly was it?
It was more or less like a suggestion. Yeah.
Okay, so I will definitely look into it. Thank you.
Okay.
Okay. Yes, thank you for the comments. I agree that in this short period of time I didn't show all the results from the exercise. But also because I wanted to highlight specifically the comparison between countries, which is what motivated this work. But this that, and also that we wanted to use a framework that allow us to focus on specific channels. So we use methodologies that were as standard as possible in order to make the comparison straightforward. And it was not easy to use exactly a very similar framework to assess both the exchange rate and interest rates, because the way they work is different. But of course, it's open to debate what is the best approach, and we'll continue to try to see if there are ways to have a more comparable framework for both impact of the exchange rate and interest rates. Yes, the selection of countries was because it was a request from the East African Community Secretariat, but we would be interested to look at the impact, the same kind of impact on other African economies as well. Thank you.
Okay. As far as your question about foreign, first you say, well, I went all over the place. I didn't quite just go onto the Dutch disease. That was exactly my point. The existing literature, I feel, is deficient in the sense that, the single equation analysis of this relationship, I think, is deficient. First, foreign aid is endogenous. In my opinion, countries, if foreign aid is meant to reduce poverty, so slower growing countries that are showing increasing poverty will receive more foreign aid than fast growing countries and so forth. So for you to just come with a single equation model, I think is deficient. I felt that this thing is simultaneous. So that's why I actually developed the relationship between foreign aid and the first iteration of this paper was just one straight equation that has been done before. And then as I read it over and over, I said, this is deficient. We are talking about trade balances and this, that. What determines the trade balance? Well, we are talking about real GDP. What determines the real GDP? On the other stuff about government expenditure and this, that, I think I'll take a look at it. Maybe rather than have government expenditures and foreign aid, I should just look at foreign aid as a proportion of government expenditure so that I can get rid of that problem that you talked about. And I thank you for your comments. Now, the floor is open for general questions. You can direct your questions at whichever presenter, and then we'll go ahead with the discussion.
Okay. So for the first paper, it wasn't really clear to me. So you started with it seems to be an extended solo model that you're using, but it was not, maybe I missed it, but it was not clear to me how the import subsidy fit into your model directly. And then I wondered whether, this was coming from a previous section, how you dealt with structural breaks, which probably would have affected your results. Ghana has been subject to a lot of policy reversals and big changes, and there's been the good Ghana, there's been the bad Ghana, and how you've dealt with that. And finally, I wondered whether, I'm struggling to read my own handwriting. So I did wonder whether the size of the input subsidy had varied a lot and whether we're seeing big differences in that. Is it just, you seem to be assuming it's just a price factor, so it's all prices and then the size of the subsidy, but whether that had varied. And then finally, whether to what extent you were taking into account the rents that Ghana was getting from oil price improvements. So the oil prices.
Rent
from the expected rents that Ghana is expected to get from the recent oil discovery. So on the one hand, higher oil prices are a problem for Ghana, but on the other hand, given that it potentially, I guess, is perceived to be a future oil exporter, maybe, there are some benefits from higher oil prices.
Okay.
Yeah. And then, so then I had a minor question for the second paper. I wondered why you focused on the VECM, on sort of the co-integration, why you just didn't look at a VAR and focus maybe on the variance decomposition, so we have a better sense of what variables contribute the most to explaining the role of stock market development on growth. So you gave us a lot of variables, but it was not very clear to me which key variables are important and how big their contribution is. And in terms of other variables, I just wondered, what about the role of the timing? So for example, what about the role of listing of companies? So you could see a lot of activity when countries list companies, and maybe that's why you have such a positive relationship between FDI and I think FDI and some of your stock market variables, because maybe you list once, maybe an investor comes in, so you have FDI, and then and then you have this big IPO and people can participate in it. So I wondered whether you could add more structural variables to capture structural factors that were taking place. But maybe I'll let the others talk before or I'll give you a chance to respond.
Can they address the question, then you get your question so that we don't get them very confused?
Okay. The first one was...
And can we do it in, say, 2 minutes each?
Okay. On the issue of subsidies, well, it is quite difficult to get actual data on subsidies. So what I tried to do was to interact prices of oil with government expenditure, because I presume that definitely the subsidies will feed into the expenditure of the government. But getting actual data, actual annual data from the span of the study from 1967 up to 2011 is quite difficult in Ghana. You can't get that. So what I did was to interact oil price with government expenditure to see how the joint effect affects growth. And then with issue of structural break in the Ghanaian economy, we had a major reforms in 1983, which really talks about the economic recovery program, which was implemented in 1983, which saw the liberalization of the Ghanaian economy from the steady period 1967 up to 1983. We used a dummy to try to control for that structural break that occurred within the economy. And then rent revenue from oil revenues. Definitely the country is going to get some benefits from oil prices, but I'm not so sure about from what I get is like the country only has about 10% of the revenue that will be derived from the oil. Majority of them are going to expatriate firms. Majority of the oil revenue are going to expatriate firms. And considering the fact that Ghana still needs much more infrastructure development, that 10%, using that to subsidize crude oil prices in the economy may actually not be very helpful for growth of the economy if we use it to subsidize oil price rather than investing them in capital infrastructure that will rather promote long-term growth of the economy. That will be better than subsidizing oil, which most of the time happens to be enjoyed by some rich folks in the economy.
Okay.
Thank you.
Yeah, so for your first question, as I mentioned, it's still a work in progress. So we did do the variance decomposition, but we just didn't report it yet. We also did Granger causality tests as well, which wasn't reported here, but it was in the paper. But also we've used the vector error correction model mostly because we still have several interpretations from the various results that we have. Like we can identify if there are any indirect effects, maybe from stock market development, which is causing economic growth through some other variables. And there is also the endogeneity effects, which are captured through this particular model. So we can find out whether there is any bidirectional causal relationships between these two variables of interest, which is why we kind of focused more on the model for a start. And as for your second comment, yes, you do have a valid point. We could have included the number of listed companies, for instance, but it would actually have used up a lot of degrees of freedom. And as I mentioned, we have limited data for Africa. But we could still try and carry out the test with this particular variable and see whether the results change or not. But I'd just like to mention that most of the studies that have been carried out looking at the impact of stock market development on economic growth focused mainly on the free variables that we used, and they didn't really include the number of listed companies. Thank you.
Okay.
Maybe it wasn't necessarily clear. So it wasn't really number of listed companies, but the timing when the country, when So the timing when a country actually, when the stock market actually lists a particular number of countries. So you could actually just control for that, which could drastically affect your findings.
Yeah.
Right? So then you're not really eating into necessarily significant
We could
into degrees
also
of
try
freedom.
that. Yeah, you have a point.
But I wondered if you could I see the data are constrained, but it would be interesting, given that you're presenting data that people have not really seen, to have some sort of event study analysis to show, to sort of thrash out some of the sort of particularities or similarities across the countries. Because when you go in and you see the list of countries, then it's very clear that, I mean, your estimation technique basically is giving us the mean, more or less. But it's very clear that the mean is going to be different. There are so many different countries in your sample, so it might be better complemented by just giving us some event study analysis or some other way of breaking down the data to get a feeling for how reflective it is of the African countries.
Okay.
Can we?
Okay,
Where-
sorry, and sort of minor other point. I think you had a very interesting story on the role of the high interest rates perhaps playing a role and all these factors. It might be useful to actually put them directly so that we're not inferring that the high interest rates could have an impact, could be explaining why you're not seeing an impact for one or two of your variables. So I question for you. Oh, sorry.
No, he had it.
Yeah, thank you very much for the presentations. My questions, my fourth set of questions goes to the first presenter. You have adopted the solo model in your analysis, but according to the literature, I think the solo theory is relatively obsolete. It seems people don't use it anymore. So I will suggest that you adopt relatively new models like the real business cycle model, general equilibrium models, so that the adoption of the new models could increase the competitive capacity of your paper. If you submit a paper in a journal and they see that you are using an obscure model, the paper may be rejected. Then, you know, in the time series literature, the VAR is the most widely accepted framework now. So, you know, although you argued that many studies have used the VAR, I think you may choose to use the VAR too, because there are different extensions of the VAR model. It may not just be you may not use the simple model introduced by Sims Christopher. We have a lot of extensions of the VAR model. So if you use the VAR model and you use a relatively new version of it, that could help.
Could you ask the questions? There may be other people and we are running out of time. So
Okay.
if you could ask questions, then they can respond.
Questions? No, I'm giving suggestions to him.
Yeah, but we are running out of time.
Okay.
We need to give opportunity to other people who...
Okay. Then my question goes to the second presenter. I think your analysis could become more exciting, like you have been told, if you separate your countries into two categories, the ones with developed stock markets and the ones that have less developed stock markets. Because, some of the countries we have included are actually called frontier markets because of the lesser development of their stock markets, while some are called the emerging markets. So you could have a more interesting analysis if you separate the countries. Then I don't know, what is the source of your data?
WDI of the World Bank.
Okay, my last question goes to the last presenter. I think you are the last presenter. In your Dutch disease, I think you have not captured the migration of labor. In the Dutch disease hypothesis, one of the elements is that labor will migrate to the boom sector. Then what is your boom sector? What is the boom sector of the Sierra Leone economy? When foreign aid comes, then how do you capture the migration of labor to that boom sector? Maybe the exclusion of that in your model is the reason the Dutch disease is not up-ed,
Okay, well, simply put, the Dutch disease literature says that if the money is spent on the non-traded goods sector, then this is what happens. So I would, we can discuss that later. Somebody has a question. Yes, somebody has. Up there.
Thank you. My question is about the interest rate and exchange rate in the EAC, East African Community countries. Some studies like yours came to mixed conclusions. Some of them say that in some countries, the credit channel is more effective. Others says that in some other countries, the monetary policy is effective when you target quantities like a monetary base. And when you come to the interest rate channel, experiences are still mixed. In some countries, they are effective, are they more or less effective? And given this, you know that these countries are pushing to monetary union. Do you think that without a prior harmonization of monetary instruments, this monetary union can be feasible? Thank you.
Yeah, thank you for the question. I agree with you, actually. We are working at the same time on different areas. The idea of this paper was to highlight the relevant issues for these specific channels, but by no means we think that they are the most relevant. In fact, in most of the empirical work we have been doing, the credit channel seems to be more important. And also there is an issue of what is the right methodology to assess that. In this morning there was a presentation by the Bank of Uganda reaching similar conclusions on the credit channel. But more fundamentally, ideally, there was another paper presented before by my co-author on trying to come up with a model that integrates the reaction function and the shocks and also the adjustment process. We did that, but that is probably more practical for individual countries. But in this case, we wanted to have a comparison in the form of a snapshot, and that was very clearly visible. And actually, the conclusion is what you said at the end, that not all countries are at the same stage, that not all countries are using instruments the way they should, and that the main concern, rather than coming up with a monetary policy framework, probably I should have explained it better, is to first look at the way instruments have been used and look at what is the most effective, because they have already concrete examples in the region showing that it can be more effective if instruments are used in a particular way. Going to the specifics, the policy rate is defined in different ways in every country. Only now there is some convergence between Uganda and Kenya and maybe Rwanda, but that took a process, and it took a food price shock before they made the decision to move closer to what we understand as the policy rate. But you're right, I mean, that's precisely the message we wanted to give, that it's better to look at the instruments and the way they are used.
Okay. Yeah, I think mine is more of a comment it's a suggestion to this lady. Usually when you look at the African stock market, in fact, it has some two key issues. So the first I want to mention is about liquidity of the listed stocks. In fact, there are many instances where people want to sell their stocks and they don't get buyers, or buyers are also willing to buy. There are no sellers also on the trading. So what I'm suggesting is that this normally results in thin trading, where some stocks, for Ghana, we've been tracking some stocks, African Champion, Aluex, and a few others, from the beginning of the year to date has not traded. All right, so this one is going to affect so many key indicators of stock development, especially market capitalization, turnover ratio, and all these things will be affected severely by the thin trading nature of the stock market. So I'm suggesting that, fine, sure, you've done the analysis. Can't we look at the extent to which volatility in these indicators affects growth? So perhaps instead of looking at how market capitalization affects growth, we realize that because of thin trading and the liquidity nature of the market, these variables are going to be very volatile. So we can first of all estimate the level relationship. Then we try and see what about the volatility nature of the market. Does it have any consistent bearing on the growth of the country? I think that would be more insightful. And for the last presenter, you made a transmission mechanism where it's suggesting that the foreign aid, when it comes an exchange rate appreciation, the farmers can still get improved in their income levels. Yeah, I think I'm right. Then I was asking myself that that will probably depend on the sensitivity of exports to the exchange rates. So suppose the exports are not probably inelastic to the foreigners, and of course, as the currency appreciates and it becomes more expensive to the foreigners, then it's rather going to reduce demand for exports, and then the farmers' income will rather decrease. The farmers' income will only increase after the appreciation if there's still demand for the exports. That's why I'm curious to know if probably exports in the country is maybe inelastic. Thank you.
So,
Well, thank you very much. You've made a very interesting comment, and we actually haven't looked at it from this angle before, so maybe we can consider that. Thank you.
as far as, to me, even if, let's assume exports are perfectly priced and elastic, a basic thing we'll learn is that if you have a low price elasticity, when the price of something rises, revenues rise. So even if the farmers sold the same 1 ton of coffee, now they can get more imported commodities in exchange for that. That's what I was talking about. I think we are out of time, but you could still ask your question. We're out of time. This is now a non-official.
I forget. So it basically was related to the first paper, wondering whether you might wish to consider using a Bayesian approach, given that more recently the literature, particularly on low-income countries, has noted that there's no real clear model to explain growth in low-income countries, and so it's much better to use Bayesian approach, where you have priors and then use that to pick up the factors that could be driving growth in that particular country. And for your paper, actually, I did wonder, you do end up with a result where you have no Dutch disease effect, but the entire paper is spent in setting up the model. You explain how the factors that could lead to a real effective appreciation. So it's not very clear why there's no clear explanation early on that sort of explains why it is and how it is that one can get the real effective depreciation in the first stage.
Excuse me?
So you spent a lot of time explaining how the Dutch disease may or may not be a negative factor. Mm-hmm. So Dutch disease, you might have a really effective appreciation, but it might not necessarily harm your trade balance. It might not necessarily hurt output growth. But I don't recall seeing a discussion on why it is that you may actually have a really effective depreciation, sort of rationalizing the finding that you see at the end. So or maybe I missed it, but I didn't necessarily capture it.
Okay. I think I explained it in the paper, but I was trying to cut through the chase. But we'll talk about it.
It was a great presentation.
Any other questions? Well, thank you very much for coming. And thank you, my co-presenters.
Thank you.